Welcome back to Finance Uncut. On today's episode, big money moving into gold. Hey guys, just want to do a bit of a shout out to you all. We've hit the 10,000 subscriber mark, which is just absolutely insane. I'm really humbled to think that we've hit 10,000 subscribers. That you guys think that the information that I provide on this channel is valuable enough to watch and come back and watch all these new videos that I do. I'd love to give something away to you. I don't have any merchandise. I don't sell any newsletters, any gold and silver. I just don't sell anything. I just here purely give an education, giving my opinion, and hopefully educating a lot of people. And I do want to give a shout out to young Sam, Benji, who works for me as an analyst, and young Geordie and Jeremy and all my students and turtles who have encouraged me to create this YouTube channel. And it was their idea, and Sam still helps with the thumbnails and some of the artwork. And you guys will know him when we have our fortnightly discussions. But you guys don't see the others behind the scenes. Benji helps out with some of the audio stuff and some of the technical gear. I have absolutely no idea, guys. So when you guys give me feedback on things, I have to go and ask them what you guys are talking about. So I have no idea. So look, shout out to those fellas, and thank you for being a part of the Finance Uncut community. I love engaging with you all in the comments, but many of you have reached out to me personally, and we've had several dialogue, and to be honest, you guys have helped me a lot too. I've got some contacts from this channel in China, inside China. So shout out to Darren and some others, and I've got some contacts. Some of you are institutional investors that have reached out to me as well, and it's been great to build relationships with you and get some more inside information, so to speak, that I can share on this channel with you guys. So anyway, with that, let's get into today's video. In this article from Michael Jander on the ABC website, house prices depend on interest rates. As one goes up, the other will fall. I've spoken about this in other videos about the data and the research from the Reserve Bank of Australia and the Senate inquiry recently, where they admitted that for every 1% reduction in interest rates, it increases house prices by 30%. So we are seeing bond yields rise. We're seeing the Reserve Bank of New Zealand raise interest rates. We're seeing banks here increasing their 3, 4, and 5-year fixed rates quite substantially now. And so what does that mean for house prices moving forward? And this as well. Debt-stricken Fantasia becomes first Chinese developer to face a wind-up petition and possible liquidation. Fantasia Holdings Group said a major subsidiary was facing a wind-up petition filed by its creditors, which could force a debt-ridden Chinese developer into insolvency. The Shenzhen-based developer said in a stock exchange filing on Thursday evening that the petition was related to a $149 million loan, of which Fantasia Investment Holdings was a guarantor. It is the first time that a wind-up petition related to offshore debts has been filed against a mainland developer or its subsidiaries. So is this all starting to play out now? And the Bank of Canada raises concerns over high household debt. And the German central bank warns of overblown property prices, with problem spreading. And the Russian central bank says that foreign investors pose potential risks to the Russian financial sector's stability.
But for most stuff, the prices are going to keep going up. In fact, if people lock down again, and if that happens, of course, what's going to happen? More stimulus checks are going to be on the way. We're probably going to come back with extended and enhanced unemployment benefits again. After all, if we order people back home, well, we already have a playbook for what to do. We load them up with cash, and that's what's going to happen. And so they're going to take all that cash and they're going to spend it, except now they're going to be spending cash when the supply of stuff to buy is even lower than it was the last time. So if we go back into full lockdown mode again, and we do more stimulus, more money printing, the impact on prices is going to be far greater and far more immediate the second time than it was the first time. And so all of this may end up being bullish for the very stocks that were sold today, and in particular, the gold stocks, because gold stocks and silver stocks got hit just as hard, and some of them even harder than the overall market averages, although there were some gold stocks that managed to eke out gains on the day. Newmont Mining, I think, was the biggest gainer I saw, but it wasn't even up by 1%. In fact, gold itself, early on, gold rose with other safe havens, like the Swiss franc and the Japanese yen and the euro. In fact, early in the morning, gold was the strongest. Gold was up about 1.25%, and that was more than the gain at that time of the Japanese yen or the Swiss franc. But traders came out immediately and sold into the gold rally. Of course, everybody is looking for gold rallies to sell, and gold actually went negative on the day for a while. I think by the time we closed, gold managed to eke out about a $2 or $3 gain, but ended up closing back below 1,800, I think about 1,792. But if you think about the two scenarios that I just mentioned, they are very bullish for gold. I mean, gold stocks should have been rallying. And in fact, the gold stocks had the biggest initial rally off those COVID lows, right? Once the Fed came in, it was March 23rd on my birthday of 2020, and just came in, with guns a-blazing and 0% rates and QE infinity, right? Gold, after like an initial decline on the announcement, which was crazy, and the gold stocks went down, it was a huge reversal, and then they didn't look back, and gold stocks made a much bigger rally off those lows much faster than the overall market. And I would imagine that the same thing would happen again if we went back to QE, or not back to QE because we never left QE, but if we ramped up QE instead of tapered it, and if we basically pushed back liftoff on interest rates to some year well beyond 2022, I think the immediate and biggest beneficiary would be gold and then the gold mining stocks. So the fact that they went down makes absolutely no sense, because either scenario, I think, ends up being bullish for gold and gold mining stocks.
And coming in from Bloomberg, Singapore increased its gold reserves by about 20% earlier this year in a largely under-the-radar move that saw holding expand for the first time in decades. And in breaking news, China's net gold imports via Hong Kong jumped 56% in October from the previous month to the highest since June 2018. And Brazil's central bank to launch central bank digital currency pilot program in 2022. And Tanzania, well, they're looking at getting their own central bank digital currency. And the Bank of Israel are accelerating preparations for their digital currency. And a consortium of Japanese firms, including the three largest banks in Japan, are to test and launch their own digital currency. Professor Richard Werner argues that the Japanese banking system are trying to get ahead of the Bank of Japan because they see the threat that is central bank digital currencies. All right, so I've shared this chart before, which just shows the correlation, which is quite high at 97% between the major central bank assets and the S&P 500. And it's quite clear that the correlation there is very high. And what we've actually seen over the last 12 months is investors poured $900 billion into equities just in 2021. That exceeds the combined total from the past 19 years. So we've had 19 years worth of capital inflows into the stock market. So there is no surprise to see the stock market rise so high. The question is this now rolling over? Are we seeing capital coming out of the stock market? So I've argued this in other presentations, other videos, that institutional investors have been telling me that they've been taking profits off the table for a little while now, and that they're moving out of risk-on assets into risk-off assets. And here's the smart money index versus the S&P 500. And well, the smart money index actually has fallen even before last Friday's slump, with the new cough, which is, anyway, I'm not even going to go there. But what I'm arguing is we've actually seen the smart money index actually decline before last Friday's market fall, and this backs up what I've been told by institutional investors, that they are pulling money out of risk-on assets. So this is definitely something to watch, folks. And so where are they likely to go? Into undervalued plays. Okay, and there's nothing more undervalued than commodities. And when you look at the whole commodity index, and what's probably a lot of commodities have had a great run in the last 12 months, and I've certainly had some good returns on most of my commodities. But the two commodities that really haven't ran up in how we've expected it to is gold and silver, is the precious metals. And so out of the whole commodity index, the whole range of commodities, I still think that gold and in particular silver are two of the most undervalued assets. And as we know, with the size of the silver market, we're not going to need too much buying to really ramp up both the demand side, but also the price side in dollars from that. So I think these are undervalued. I did a video. What was that video? I think, the 61% gain coming. So I did this video. It was fairly recent. And what I just argued in this video was that even at today's prices of the underlying metal, that even though I think the underlying metals are undervalued, in this video I argued that the gold stocks, the gold mining index, was 61% undervalued based on its historical trend with the underlying metal. And I know you guys are waiting for my crisis investing video, which I have promised that I'm doing, and I was hoping to have it out at the beginning of this week. I'm still recording it, I'm still putting it together, and you guys are going to love it. To be honest, just going over the crisis investing book from Doug Casey has been wonderful, just to put things into perspective, because it was written in the 1990s, or this version anyway, in the 1990s, and he shares, his results from his book that he wrote in 1979, and shares the things that he predicted in 1979 and how a lot of it played out nicely, and then some of the things that he said in his 1990s book which played out real nicely. And some of us have recency bias, and so we all we can see is what's happening right now, and we can't pull ourselves out and see the bigger picture over a longer time period and see how this all plays out. But if we are seeing this risk on, people selling their risk on assets, this is where you want to be positioned into risk off assets like gold and silver before the capital really starts coming in. Because when the capital starts coming in, the gold and silver markets are so small, you're not going to need a lot of that capital to come in there to really push this thing higher. And, in the book, Doug talks about, these are the commodities market and precious metals markets work in cycles. So you don't want to be buying at the top. You want to be selling at the top. And I'll talk about when Doug says to sell precious metals in this next video. But you want to be positioned before the capital comes in. And that's where I think right now we do have an opportunity. Gold and silver have been smashed down and they are undervalued. And this is where you want to position yourself, sprinkle a little bit of time, put it in the oven and just wait for it to cook. And the rewards will come. She'll taste really nice, trust me. Anyway, guys, what do you guys think? Love to see your thoughts and opinions in the comments below. If you like this video, please hit that like button. Really do appreciate it. Take care, and I'll see you again on another episode of Finance Uncut.